It's worth giving up control to investors if that means faster growth.
What are the pros and cons of seeking external funding versus bootstrapping? When to seek out external capital? When I started SendLane, I bootstrapped that thing for a couple years just getting going because I didn't think anyone would give me money without any real revenue. What about relationship versus freedom? During the time when you got acquired, you were still working for BattleBox. You obviously had someone to report to. Did it feel different?
The silver lining of it is I was which I hadn't ever done previously.
So Mayor, you went to go fundraise. It didn't work out. Tell us the story a little bit.
We really pushed for a year and a half before we finally said this is not going to go anywhere. In that year and a half, I probably could have also done a ton more bootstrapping work to even get that off the ground a little bit more.
Robert's Pizza, what was it, 8.2?
No, Portnoy gave it a
7.9. And then what was Sally's that we had in Connecticut? 8.2, right?
It was in the 8s.
Yeah,
It was,
I know.
I think like 8.8 or something. It was very high.
No.
Yeah, it was very high.
Antico's in Atlanta, I think, was like an 8.1 or an 8.2.
Interesting. I don't know. It was really good last night.
Although I am upset we didn't get a cheese pizza because Amir decided to get mushroom.
He ruined it. Well, he didn't like it either.
Yeah, I know, but he wasted a whole pie on it.
Yeah, I thought it was going to be better.
It wasn't good.
I agree. It was not as good as I
I
expected.
know, but if you're going to venture out to a mushroom, let's get half mushroom, half cheese.
There wasn't an option.
Yeah, it's all or nothing.
All right. Let's shoot this pod,
I will
guys,
go
off.
buy you a slice.
We're going to shoot the pot off.
And then you guys can have a pizza later and talk about this later. Cool?
I've had enough.
All right. 3, 2, 1.
Welcome to the awesome pod where we talk a lot. E-com is the path that we walk a lot. From 4 point of views when we're talking shop.
What's up, everyone? Welcome to the Awesome Pod, a show about perspective from the eyes of an agency, SaaS, operator, or marketer focused on the D2C and e-commerce and retail space. Over 55 years of combined business experience founding over 12 different companies in our careers, we're excited to bring you this episode. So I'm going to go around the room here and I'm going to introduce everyone. So first and foremost, I've got John Roman, the Android-loving survival king. He's the CEO and co-founder of BattleBox. Then we've got Amir Grasinic, formerly known as the Prince of Bosnia and now the mayor of Chicago, because he showed us all around and he's been hyping us up how it's a top 3 city. I disagree. Top 6, maybe?
Top 1.
Okay, there you go. And then I've got Brian McDonald over here, who's the self-proclaimed funniest dude on LinkedIn and also the meat guy. And then my name is Jimmy Kim. I'm the moderator, 3-time founder, former D2C brand owner, and email and digital marketer of 15 years. So first things first, where do we hang out, guys?
Creators
Combine.
There you go. So Creators Combine is where the awesome community can be found, available for founders and operators, agencies, SaaS operators, and marketers. We've got a lot of great people in there. It's a really fun little community. And don't forget to subscribe to awesomepod.com to be alerted and join our future newsletter. All right, guys, look, we've all been there. Envy. And what I'm talking about is when you see a friend raise a ton of money, right? And you're just wondering, what could I do with that money? But the truth is not every business really actually should be raising money. And not everyone is ready for the responsibility of raising money. In fact, this stat is pretty cool. I was shocked by that, but only 5% of startups actually raise any VC money.
It's not a lot.
Yeah.
No.
And I'm not talking about friends and family. You can do that, the angel rounds and all that stuff, but VC money. And I never really realized it. And that led me to 6 things that I want to cover in today's podcast, which the topic of today's podcast is fundraising and bootstrapping, the entrepreneur's decision, and talking about when and why and where, right? And I think we have a lot of experience in this room with different parts of it, from the bootstrap side to the funding. But the 6 things I want to cover today are like this. 1, I want to talk about the initial decision. 2, the timing and growth. Like, when is it the right time to make that decision? Let's talk risk tolerance and entrepreneurial mindset, like the mindset that's required to make this thing happen. Then we talk about relationship versus freedom, because I think that's something that does become a difference between the 2 decisions there. There's a lot of lessons learned around this room and we can talk about them. More about the future, the way the world has changed over the last couple years. The reality is we're not sure where the future of fundraising is really going, as we're seeing things change dramatically today, even in the technology sector, as when we go. And then at the end of this pod, we've got a little fun game here today. We got a game called Buy or Sell, and that's going to be hosted by Brian here. More on that shortly. Let's go ahead and start with, he's so excited about that. He's so excited. That's the only thing he's going to be waiting for. This is going to be like that JC Penney thing where Amir just jumps in and I've just been waiting to tell you guys about this.
The whistleblowing episode?
Yeah, the whistleblowing episode.
The whistleblowing episode. That's episode like 18, I think. We should check it out if you haven't. All right, so let's start off with the initial decision. You're starting a new business. What are the pros and cons of seeking external funding versus bootstrapping? Who wants to start there?
I'll start us off. One of the big things is, I think it's a lot easier sometimes to not have to use your own money and to eliminate that risk. If you have investors that are willing to take the risk for you, I think that's oftentimes a major attractive piece. I think it's probably a little bit more the case with software and technology than it is maybe direct to consumer brands.
But is it really about the risk tolerance of your own money, or is it really the fact that you can accelerate faster?
I think it's probably a little bit of both. I see what you're saying. You definitely can go a lot faster. But I mean, there's all kinds of other factors. You know, it could be the concept of it being smart money, right? Getting some investor money of people that have done this before, have been in the space, have seen what growth and scale look like. So there's value there too. I think there's a bunch of things to take into consideration.
There's a lot. Like, you have to figure out what the goal is. And like, when you're first time on, and I think this is where it gets really big. First time entrepreneur versus multiple second, third, fourth time. When you're the first time, you don't know. You know what I mean? I don't know about you, John, but the first time I got online, and this was years ago, I had to go figure out how to buy a domain name, how to set up like little things. Now I just fly through this stuff.
Sure.
It's natural instinct. And the timing of being able to speed through these things are much faster. And so it's the question I think that we continue to think about is, what are the pros and cons? Like, so let's go around the room. Let's start out with some pros. What can you do? You can go faster. What's another pro?
I think you have more to fall back on. You don't have to worry about payroll right away and have the stresses of keeping the business alive, because you figure out your burn rate and you know for how long you can operate, hopefully.
What else? You're not at the risk of money, right? Like, you're risking your own money. You could get paid, right? If you're raising enough of a fund, you can put yourself on payroll, because good investors don't want you to be worried about money. They want you to be focused on the role. And yeah, I mean, to your point, it goes back to speed, right? Like, I think speed is probably the biggest pro, is that you can go crazy and you can attract the right talent. What about the negatives? Let's talk about the negatives right now. And again, we're going to stay high level on when you're thinking about it. What are the negatives of bootstrapping?
I mean, the first thing that always comes to mind is lack of control. You're not fully in control anymore.
Got it.
And
when you fundraise.
Yeah, and depending on the deal, especially some of the deals I've seen in the last couple of years, the ask from investor VC money sometimes is a little aggressive.
Yeah, we'll break that down a little bit more when we go through this. And I know we had a big episode about this before, but yeah, that continued thought process is very much there. Like, you're working for other people as an entrepreneur versus working for yourself or working for whatever. And now there's stories, teams, and, you know, different ways to raise money to avoid that through angels and family, friends, and people who trust you. Like, there's a lot of ways to think about it, but the reality is it's, you know, a little bit different.
You're also limited to, if you decide to go the bootstrapping route, if you don't have an exorbitant amount of capital, you're limited to the amount of ideas that you can implement to start your business, right? Like software, there's only so much you can do with a little bit amount of bootstrap money to actually create whatever software that you want, right? If we're talking a D2C brand company, there's only so much inventory that you can actually acquire, so much paid ads that you can run based on the amount of money that you have to work with. So you're limited in regards to what you can implement and build based on what you have saved up in capital.
You think it's like failure points? Basically, you have less chances to fail ultimately, is what
for
you
sure.
said in a very indirect way ultimately.
Yeah.
The other thing I think too, on both sides, time is a big component, because I think there's certain people that are in a better position to raise money and they can do it quicker than others, because raising money is a lot of work. I don't know how it is now because of COVID and everything, but I remember
Still the
when I
same
had
work, man.
Is what?
Still the same work, just more Zoom meeting.
Yeah, but before, people used to drive from like city to city, sit down, meet with people. I mean, it was like exhausting for people to do it.
Yeah. Okay, so you're right, like going to a place, right? So like, think like this. This is the way I say about fundraising right now. You used to have to go to a place, meet once or twice, send a couple things, and then you might get a funding offer. Now, because Zoom's so easy and available, more people want to talk to you and they want to do more interviews and they want to do more talks. So it's actually more work on the other side. Yes, it's easier from the seat of your home to do it, but you actually have to do more meetings because the meetings are more available.
Yeah. But then on the other side too, if you're bootstrapping, it also takes a very long time sometimes to bootstrap a business if you don't have the right distribution or network to get it going too. So like, I think a lot of people always wonder, like, should I bootstrap today? The question is like, what's the better fit for you? And I think sometimes people gamble on the wrong one. And I was one of those people early in my career. I tried to fundraise and I'll get to it later, where I completely failed because I was just doing the wrong thing and I wasted a lot of time.
And, you know, myself, as we're shooting this pod right here, I should have announced it publicly by now anyways, but I'm starting 2 new businesses right now. There's 2 new things going. And actually, in the funny way, I've bootstrapped one and I've fundraised on the other one. My initial decision was like this. It's a cash flow thing, ultimately. It's an alignment thing for me. That was a big thing that I thought about, like getting the right people on the cap to help you move forward. And ultimately, I think that it de-risks myself also, right? Because the risk that comes with bootstrapping 2 businesses would be incredibly high, because now your focus is going to be to be driven on the money on the one business, and then they're going to be focused on money on both businesses ultimately, which you don't want that to happen. You want to be able to take a business that has something that's working, and if you're going to be able to accelerate that and you want to grow it and you have already something moving, it's easier to get it going. And I think it's interesting because I say starting this two businesses, the second business, the event business, already has traction. And I think that's the key is I'm not starting fresh. I'm not starting from thin air. I'm starting in a place where I have traction, proven success. I just need resources because it's a cash intensive heavy business. And so I had to make the decision to raise money, but didn't go traditional and go raise money. Even though I could have knocked on plenty of doors and got traditional money, I went to find a group of people that I believe would be helpful to the business growth. So I think there's a lot of decisions. I mean, I just went through this decision, someone who's bootstrapped multiple businesses and then fundraised a huge amount of money and now coming back. There's a lot of pros and cons ultimately. And you guys nailed it, like all the things we do. And we'll talk about a little bit more of that. But let's move on to the next part of that topic, timing and growth. Like when to seek out external capital. That's the question I want to ask right here. At what point does seeking funding become necessary? Or can you bootstrap it and chug along? And you kind of mentioned it a little bit earlier, software. Or if you're producing a product that has deep R&D, right? If you're going to go change something up, do something deeper, like I'm going to go save the world by creating a like the Illumi, for example, with Matt, he's got a compostable thing that sits in your kitchen that you put your scraps into it and makes dirt. I'm sure that took a lot of R&D work and effort and time, and he raised money to do that, right? Those make sense. And traditionally, a lot of times, until actually 2017, in my humble opinion, like 2018, fundraising was never about the initial concept often. It was much more about the growth concept, right? I have something, it's working faster and faster. Now I need to take on money to accelerate it faster. And that's what most people like. Early stage, pre-seed funding, pre-business funding. That's a little bit newer category, in my humble opinion, that's happening in this market. When I started SendLane, I bootstrapped that thing for a couple of years, really just getting going because I didn't think anyone would give me money without any real revenue. What do you guys have thoughts? Like, when's the timing that you think? Like, John, I'll start with you here, man.
Yeah, so I think you nailed a piece of it is if you're raising money, it's going to be based on some sort of valuation. So in that mindset, that thought process, then you want as high a valuation as possible. So you want to take it as far as you possibly can yourself without hitting those limitations. It's tough, right? It's not an easy, straightforward. I think you get it as far as you possibly can without money.
Yeah. I mean, that also brings up, and I know we talked about this a couple pods ago, but that always brings up that whole valuation number, which is a hard place for most entrepreneurs to swallow.
Most entrepreneurs aren't realistic ever with valuations. They all think that their stuff's worth all of this super high number and the reality is it very rarely is.
Yeah, especially in the D2C consumer space. I think physical products, especially if you have nothing special. Like if you go and develop something for 2 years and you have R&D behind it, I see the value behind it. But if I can buy your product on Alibaba or AliExpress and buy something pretty similar, it's not special. Yeah. And then the only thing you have after that is brand. And if you're too small, there is no brand, right? Or it's a micro brand, which really doesn't matter that much.
Can you please make me a new Recharge rap song for the Awesome Pod really quick, please?
Recharge did a rebrand, so I drew up a new song freehand. Now it's tailored, fit tight like a glove. Automatic revenue, that's what we love. Your product's the bait, Recharge is the hook. They'll read subscribers like open books. You probably looked through every open nook, but you found Recharge, close your open book. Wasn't that easy? Sure was. No hassle, no sweat, they'll help you build your park like Walton, turn your castle into Jackson. So don't give me that, I'll check it out tomorrow, man. Get Recharged today and hop on that tomorrow brand.
What do you think, Mayor? When's the timing? When you decided, and we'll talk about the failure of the story later on. We don't have to get into that. But when you made the decision to go raise money, why did you think it was the right time to raise money?
I thought for me, I wasn't smart enough to realize that I could organically prove out the concept. And what happened for me is at that time, fully transparent, there were the stories of the Zuckerbergs of the world and all these people.
Outside influence, right?
Yeah. And it was like, okay, if they're doing it, I can do it too. And I don't think there's anything wrong with that mentality. But my inspiration was like, if I can live this, or I can get this boost to quit my job, focus on this, and have this capital from a partnerships, investments, and advertising standpoints, my growth would be a lot faster with the plan that we had. And we'll get into it later. But that was like my notion behind it. I had built the platform for it, the website and everything. But it was, to me, was like, okay, how do I take this to the next level? And I made a lot of mistakes during that path because the way I approached it was was completely wrong. And I know that now, but at that time I was 22, 23, and I didn't have really any mentors that have done it before. They would tell me from a fundraiser. I had a lot of really smart mentors that helped me with P&Ls and all of this stuff, but not from like, hey, what do you need to do at a core level to raise the money that I was looking for, which is, I believe at that time was like $250,000 we were looking for.
John, I'm going to flip you on the other side because you also invest in companies. You got a venture fund that you operate out of. When do you think it's right for a company to be seeking money, capital?
When you flip it like that, I want as early as possible, and I want it not to be very proven out.
So you're an early stage investor, right?
Yeah.
He's a risk investor.
Yeah, he's a risk investor. He likes to play basically bingo with his investment money. That's what most early investors is.
No, I see what you're saying.
Yeah.
But yes, on the early stage, but no on the bingo piece, because part of the criteria for me is that I have to be able to have involvement in the business, not a check.
Got it.
I'm an active investor, and I have to be confident enough that I know that I can actually bring value, like beyond a shadow of a doubt that I can bring value to that business.
No, we're gonna walk back on that in a bit later, but I think there's a lot of thought to it because in 2021 into 2022, I fell into the hype train and I wrote a lot of checks out. And man, it's been not so pretty. I think I wrote out maybe about 200 grand in checks out into probably about 11, 12 companies maybe at this point. And it was interesting because writing those checks out and putting that money out, I thought I was being smart. I did my due diligence research, very passive, right? Truly angel investments, writing checks between 10 to 50K is what I was writing checks out for. And as time has gone by and the last 2-3 years has happened since then, I've had one go under completely, right? Lost that money. I had 2 acquire, but they sold for less than I invested in at that round. So I actually got less money back. So I for example, there was one I put 10 grand in and they gave me back like $4,500.
And they got acquired.
And I got a public stock at 45. And then it proceeded to go down afterwards after I got the stock in my, because that's how they give you the thing. And then I've got a couple that have done some crazy stuff. I saw one get funded by Sequoia and I'm like, okay, this one might be the rocket. Yep. But in the early stage of investing, the idea is you go invest in a lot and you play a little bit of bingo because you're only looking for one to pop.
Yeah, one out of.
And I might have that
10.
one to pop. It's a sports betting API product. I don't know. I thought it was cool. I thought it would make sense into the future. So I bet into it. And then Sequoia put like 20 million into it. And I was like, we might be onto something, guys. We might. So there's my one investment, my one horse. I've got a couple other horses that seem to be doing okay. But for me, when I make a decision, I need to see some traction. I need to see some reality. But I also, the biggest thing for me as an investor side is I need to feel like there's a real future in what they're trying to build towards.
Sure.
The thing with that too, though, for me, and maybe more of a question for you, John, I remember when I used to watch Shark Tank and you have these billionaires or multimillionaires proven out, and they would always say, love the idea, but not for me.
Correct.
And the older I get, like when I was younger, it's like, why wouldn't you invest? Such a cool concept, it's going to make money. But I get now what investors mean, but not for me. Doesn't mean it's a bad idea. It just means that
I think it's a combination. Also, like complete courtesy though too. Like they're trying to be nice because they're on TV.
But no, I mean, there's some been really, really cool.
That's a great idea. Yeah, I'm out though.
But here's the thing. If somebody comes to me tomorrow and they have an incredible idea in automotive and say, hey, Amir, can you write me a $10,000 check? I'll probably say no because I know nothing about automotive. But I would have to make a lot of
Jimmy.
Yeah, but I would have to make a lot of phone calls to really understand the business. And if it makes sense, where if somebody comes into e-commerce, SaaS space and all of that, I'm like, okay, I can evaluate. I have enough experience to right away know, like, is this a really good idea or is somebody just reaching? That's, I think, the difference.
I can also say that I have hundreds of emails in my inbox from investors that said, man, you have a great idea, great opportunity. It's not for me. Let me know how I can be helpful. That's like the way they turn you down.
It's
of
just
course.
courtesy. Yeah.
It's courtesy.
But I think it's both sides, though. I think there are investors that don't go into something just because. Would you invest into a business that's a great idea that we cannot be involved in?
No, but that's
so it's
my
not
criteria.
for you.
My criteria is if I don't think I can bring value.
Yeah, but so it's not for you, right? It's not a bad idea. It's not
Most
for you.
early stage guys.
I don't know. I can bring value to a lot of stuff.
So you never said no to anything.
No, I've said no to way more stuff.
Oh, okay. My point.
But a lot of investors, early stage investors, often bet on the horse, right?
Yeah.
The person who's running an
That's a
operating
big
thing.
skew.
Yeah.
Like, when you have someone who's willing to run through walls and they're passionate about the thing they're working on, even if they pivot 16 times through the trajectory of the business, they're going to find their path. And I think that's what you have to figure, because a lot of times and often is those early businesses don't have what they know. They don't know what they're doing. In fact, that leads me to the next part of this topic, which is influence of growth and speed of organic versus like the growth and speed of the business based on funding versus bootstrap, right? Does it really affect it? And it's something that I think people, obviously, I think the answer is very clear, but I wanted to see if you guys had any perspective around, and I'm going to go to Brian on this. You live in a bootstrap world. What would you do if I gave you another $1 million right now to go invest into the business right now?
Yeah, I mean, right away, it's just new acquisition. So like in our space, right, like the farmers dogs of the world that have come about, all obviously fundraise VC money. And what they're able to do is they're able to say, okay, we'll put 30 million into commercials. We'll put 50 million into the Super Bowl. We'll go A, B, and C, where versus us, it's, hey, we have a few grand to spend, right, on that new customer acquisition. So the actual business structure and functionality and manufacturing, all that stuff's all set in place. It's just now a matter of compounding that in regards to new customer acquisition. You know, that for us, if you were to give me from like $8,000 a month and now you give me $80,000 a month, like there's no reason why we can't.
Would you get more riskier and crazier because you had the money available?
I wouldn't initially, because I know the channels that I need to go at first. Now, once I prove those channels, then I would get wild. Then I would get absolutely wild.
We've seen this man double down on like a 12. So, you know,
I would get wild.
With like, what was the dude?
I don't know, it's like 8 or 9 showing or something.
Yeah.
He's pretty wild.
Yeah.
That's why I asked you about the growth and speed. And I think the big thing about funding versus bootstrap, and you might relate to this, John, about this, is when you're bootstrapped, you don't we all have growth targets, right? Ultimately, but the pressure of the growth target is different. And what I mean by that is bootstrap, if I tell you I'm going to grow my business 3-5% month over month, cool, man. Like you're not investing more money, or you're investing very little money and you're growing 3 to 5. It's great. But in the world of funding, and if you've been funded, there's a different expectation. Your investors, your board, your different people are going to expect different things. They want to see real growth. They say the world average business, like a good high growth business, is like 30%. But for example, in the software world, you're trying to triple, double, right? That's the $100 million path, right? To go to an IPO. That's what they call it. Over 5-7 years, you triple every year, triple your revenue, triple, then you double and whatever, right? That's super high expectation, which is why they need so much money, right? So there's a lot of that comes into place. But that does come into this thing I call risk tolerance and the entrepreneurial mindset that comes in. Bootstrapping often means managing different risk versus how an entrepreneur may deal with uncertainty differently because they have money versus no money, right? Amir, I'm going to start with you here when you think about risk tolerance, because I think you're the least risky out of all of us because you bet $5 slots when we bet a little bit more. And so we're going to go ahead and talk with you first. But when you thought about bootstrapping versus and trying to raise money, did you think about the risk tolerance there? Because now you're playing with other people's money.
No, because the way I operate and the way I see things is that I owe something to these people. And again, they're trusting me to make them money. That's why they're investing into this. They believe in me. And as a return, I would need to be very accountable to them and to their expectations or the expectations we set forth. So to me, like when it comes to risk tolerance, you know, if I have your guys' money or my money, I treat it the same way. And it's like, what would I do with it? And to be honest, it's like, I know you said you would get wild with certain things, but one of the things I like what you said is you would test different things and then get wild after it's proven out. I would take the same approach. Like you want to make sure that there's a return on this investment, literally and figuratively, and you scale it from there. So to me, like whether somebody gives me $100 mine or theirs is the same thing. There's been different things actually John and I spoke about regarding different investments and things like that. And even if it's a friend or professional environment or somebody looking for advice, if I was running their business, I treat that the exact same way, as long as I can have the right information from the other party to dive into that very deeply. So to me, I don't know. I don't see it. And I've been around founders where they'll just say, well, we raised X amount $1 million. What am I going to do? I'm going to go rent a bar and blow $100K. And it's like, dude, like I would never give you a penny if you asked me for investment, because I would never do that with somebody's money.
That's interesting. John, you got a thought to that?
Yeah, I think traditionally when I think about myself, I'm pretty risk adverse, which is kind of unusual to be risk adverse. I didn't jump into BattleBox full time until our run rate had us in high 7, low 8 figures. I can appreciate what Amir's saying there with raising money and how it's spent. You and I know, all of us know, so many of the B2B e-com people that raise money and how they just blow it. And it's just wild to me.
It is, because it's a growth expectation. It goes back to the growth side.
Yeah. And the way they're spending it is not going to accomplish.
So there's a saying, you know, when people say like, oh, you can never spend $5 million, especially in SaaS business, B2B business. By the time you get sponsorships, events, this, that, you can blow through 50% of that.
$400,000 for 12 months is $5 million.
Yeah.
That's not much. When you're building a SaaS company, especially when you have very low revenue and you need to build and you've got engineers that are costing you $250,000, $300,000 a year, dude, that money goes fast.
Yeah.
Real fast. And that's part of it, right? The challenge of a startup is you've got to catch up to the incumbent. And to catch up to the incumbent, you need to grow. Fundraising allows you to grow and get there faster. But the thing is, allows you to get there in a faster time. But there's a lot of things that come negative with that. And the big thing that I always say with the negativity about it is when you see companies grow fast, they have more problems within the business because they've been ignored. I know I did. I've had plenty of problems because we've ignored the problems because your growth target was all you went after.
Yeah. The first boss I worked with, I always asked him why I never raised money. He said, I never raise money from investors because I want to do what's best for the business and not what's best for them.
Shareholder value.
Yeah. And he goes, you can't do both. He always believed that.
That's a great segue to the next part of it, mindset behind it, right? What does it change that mindset? I kind of tapped on that mindset there, but the growth at all costs mindset, which I think is dead now. I think people have given up on that concept, but if we zap back a couple of years ago, there was a thought where it was like, hey, if I spend $1 million and I can add 300 grand to my business, like it didn't matter. Even in the D2C space, it didn't matter if it was in SaaS or D2C. It was like, hey, like I'm going to go lose 20, 30 bucks per customer right now because I know I'm going to upsell them in the lifetime of their value of their customer and increase my CLTV and get there, right? It's a little bit different now. I think people have started to recognize that it matters again. And I think it's been like up and down because the one thing, and I know we beat up on drop shipping, right? Like the old school drop shippers. Yeah. If there was one thing those drop shippers were good at, you know what it was? It's making profit.
Yeah.
They knew how to turn a profit. Yeah, their products weren't great, but they were great marketers because they were selling the product and they were making a profit on sale number one. They didn't care about sale number two because most likely there is no sale number two. Right. So they're all making that margin on that profit. So I think that mindset is actually an extremely strong mindset. And it's really hard for people to grasp around there. I think that's the challenge, that people can't grasp the idea that you can do it profitably and grow profitably. And I've done both sides of it. So I know what happens. And I've also had the detriment of just falling into that and trying to grow at all cost problem. Let's keep going forward. What about relationship versus freedom? This is a good one I'm talking about the investor relationship versus the freedom that comes with Bootstrap. When an entrepreneur takes external funding, you've got John sitting there who wants to be an active investor. That means he wants to be in the business, which does, no matter what, will create new pressure and potentially a challenge to some of the freedom that an entrepreneur may have. Mary, you've been bootstrapped now because you didn't raise money. You can make the decision how you want to make whatever decision. I mean, you've got co-founders and stuff like that, but ultimately you're the CEO. So you're making the decision around all this stuff. How has that thought process been? Have you seen it versus maybe agencies you've seen get funded or ones that have gotten rolled up? Like, talk to me about that.
Yeah, I've spoken to agencies that got acquired from both sides where they really liked the acquisition and it worked really well for them. And I also spoken to agencies that were just miserable. So I got exposed to this because the first agency I had, we actually sold it. And then we had to work for an acquirer. The acquirer was supposed to invest money into the agency. And the company that acquired us, their CEO and everything, really great guy, can't say nicer things about him, but we had different opinions in the way the business should go, they should run. Everything from, HR handling to, how do we get return on everything that we invest on and things like that. And his big thing is before we pulled the lever on anything, the question was always, if we put $50,000 into this, what is going to be my return? I have no freaking idea. It's just like one of those things, especially if you've never done this before, we have to carefully test it. So now when I test things, whether they're dinners, whether we go to conferences and all of these things, I understand where he's coming from, but I appreciate my approach more because I look and evaluate things over a longer period of time. I understand people don't make websites every year or every month. I know that I have to establish a relationship over 2 to 3 years. Nathan, who we spoke about yesterday quite a bit from Pipsticks, I've known Nathan and met through a conference maybe 3-4 years ago, and we just started working last year. And we had a great friendship and relationship. And then Nathan hit me up one day, said, hey, I want to do a redesign. Are you interested? And that's the way it happened. I wasn't a hard selling, I wasn't anything, but I realized all these relationships and everything I'm growing, something you actually beat me up on, brand. I understand I have to build my brand, I have to invest into it. And I like to be able to control that narrative. There's certain signals in our P&L and everything that we do that I value through my investments, but I feel when I talk to these agencies that got acquired, they don't like it. It's how can I get the return on the investment that I make into the position that I make? And sometimes it's trimming staff. The service industry is the largest investment we make is people, and they trim staff, they burn people out, the founder has to work more hours. But then on the other side, I've spoken to a couple of founders that they were grateful because the strategic partnerships they got out of it were people who've done this for a longer period of time, had better systems in place. So I just think it's not necessarily like what company acquires you, but I think it's more what you said too, is what strategic placements and complements are they going to be once you merge together? Because I think if that's not aligned and you don't have the mindset of we want to go into this direction in this style, and I think from my experience, if that match is there, it just makes things a lot easier to go through that process.
All right. And John, I'm going to go right over to you because I think you've had an interesting story because you've obviously been acquired and you bought it back. But during the time when you got acquired, you were still working for BattleBox and doing the thing. You obviously had someone to report to. Yeah. Change the did it change it? Did it feel different? Like, talk to me about that.
It didn't feel any different. I look at like the silver lining of it is I was sending a weekly report, which I hadn't ever done previously.
So you're doing more work.
Yeah. So more work and busy work. There were some best practices that we got from it. There was the way some of just the annual auditing that we kept moving forward. Yeah. It wasn't that bad, but it's definitely different.
So you got acquired, but the other part too, you got acquired by a public company. So that also changes things as well.
Oh yeah, that part sucked.
Okay.
So because they were publicly traded, the auditing and the financials, the reality is I didn't have to deal with those.
Did you have to hire different people to add into the team, or did you have to?
No, the team we had the core competency. It was just a lot more work.
Yeah, that makes sense. I think that freedom side of things is really interesting because I come off of obviously building SendLane and moving on to do other things. But the biggest thing for me as I look back at this last couple of years, it's a difference of freedom and like allowing me to make my own decisions, allowing me to move fluidly through whatever I want to work on and not feel like I need to go report to other people versus having this group of people that I have to report and tell them what's happening and almost sell them on what I'm working on. It would almost felt like a monthly sales pitch, basically. And every month I had to sell them why we're doing a great job, why we're this and that, and why you guys should continue to trust and believe in us and hopefully maybe even fundraise into the future, right? And it becomes this weird cycle. And I like the accountability. I'll tell you one thing, and I don't want to beat up on it the wrong way either. I think the accountability taught me financial sense. I think that over the last couple of years, especially running the company since we took on that large investment in 2021, it made me a better financially aware person. And before I would just, whatever the top line number was and whatever the bottom line number was and how much money came out, that's what I focused on before. I was bootstrapped and I wasn't thinking about it. But as I got into it, I started looking into the P&L. I dig into the numbers. I challenge questions, and it probably makes me more savvy as a business person. So there's positivity to having that accountability, because a lot of times entrepreneurs, as you know, and all of us know here, we're a little bit fly by night, man. We like to roll with the punches, and we're okay taking big risks, as we talked about, in different ways. And they're not really big risks, at least in our heads. And I think this is the weird thing, like, in our heads, sometimes we do things, they're not that big of a risk. But in the world perceived, geez, we're doing some crazy ass shit sometimes. You know what I mean?
Yeah. So maybe I'm not risk adverse. I just think I am.
Yeah. You just think you're risk adverse because you think you're smarter because you're like looking at and thinking about it, challenging it. But dude, everything about entrepreneurship is risk averse. Let's be honest, John. Let's take the acquisition and like the purchase off. If you didn't get acquired and you were just making your salary, you probably, and I know I wasn't, making more money than I would have if I would just gotten a high powered job that I probably am qualified for.
No, you and I have chatted about this.
I would have made way more money if I just worked for Facebook and just did my
Or
thing.
You and I become salespeople at Salesforce.
Yeah, or Salesforce salespeople. Yeah, Salesforce, if they're listening to this.
$500,000?
Yeah, they pay like $500,000 to $1 million, those guys. Dude, I'd be a killer Salesforce AE. Like, I know exactly what to sell those people. Dreams. So, all right. Let's keep going here. Bootstrapping often is also tied to a slower growth metric. And Brian, I'm going to go to you about this because I think that what I've been very impressed by with at Almost, as you've been growing this thing at Bootstrapped, is you're not spending money in the typical fashion, paid media, and you also are limited in budget, so you're not going out. You spent time cutting budgets to find ways to get more money to help you move forward. How has that changed your mindset? And like eventually, and maybe one day, someone invests in a company and gives you a bunch of money, but like, how have you thought about this route of bootstrapping ultimately?
Yeah, I think it's when you're bootstrapped. So like I'm in a weird position where I'm not only running the e-com side of it, but I'm also involved in like operating with Adam. So it's cool to pull back the curtains when you are limited to your budget, because now money has to come from within. But when you're also having that slower growth rate, but you're growing at a positive like 20, 30, 40%, that's fantastic. However, as you want to accelerate that and remain bootstrapped, you have to look for ways to pull money from within the company in order to do so. So without getting rid of people, how do you do that? We don't need to get rid of anyone because we know that everyone's necessary. We don't have a big staff. It's like, okay, well, what are we spending in this department, this department, and this department that hasn't been looked at in a long time? So when I sat down with everyone, and this is where I talked about bringing that like fourth generation family business up to 2024 true company mindset, right? Small family business, company mindset, two different philosophies. Company, now we're looking at our P&L, our financials, what we're spending, procurement, and okay, well, wait a minute, we could save 200 grand a year and not affect product quality. All right, now that 200,000, right, can now be pushed for whether we had to buy a new machine for our manufacturing plant, and that doubles our output of certain products. That we would have had to take out a loan. That would have screwed up the P&L big time, when in regards that $200,000 was just sitting there. And now it's okay, we did that. Now let's look at the next biggest expense, which was dry ice. All right, now we found that in dry ice. There's another $250,000. Before you know it, right, we're at like 700-800 grand just in 3 different products, right? 3 different procedures that haven't been looked at in the company in quite some time. So I think as a bootstrap people that are listening to this, there's so much money within your own business without having to get rid of people that just has been neglected for so long, because that growth mindset on the marketing and sales side takes priority over the little boring things. And you add up a bunch of little boring things. Next thing you know, you've just...
And it's not even just getting rid of people. It's like, if I need to create more budget for myself, this is the way to find budget, right? How do I find budget within? In the earliest days of my business, like, I'm talking 2008, 2009, when I first... My thing was always, I want to go do something. I need to go make that money right now in order to pay for that thing. So I'll be like, and you guys know I like nice things. I always like nice things, even back then. And I'd be like, I really want to stay at this hotel, but we can only afford this. We need to make the delta. And I remember there was one time it was like a couple grand delta. And I was like, what can we do today to go make a couple grand to pay for that, right? Because I wanted it. And we did. We always delivered.
I've done that before.
See, you've done that before, because we think about, you know what? We got to find a way, and whatever we can do to get it gone. You know what I mean?
Salvin advisors, data's on the rise, helping e-com brands smash profit highs. Not just AI, real humans with a plan, entrepreneurs with data in their hand. Understand, this ain't funny, like Keenan and Kel. Is that your P&L? What the hell? You need some help, and that's okay. So what are you waiting for? Hit up Salvin today. No, seriously, your P&L looks like an episode of Botched. Do yourself a favor, head on over to salvit.com today.
Let's jump into the lesson part of this thing. And I know Amir's been itching to talk about this, but Amir, you went to go fundraise. It didn't work out ultimately. Tell us the story a little bit.
Yeah, so me and one of my best friends, Sam, we wanted to start this business we call it Desk Quest. And what Desk Quest was going to be is basically an auction system for high-end luxury vacations. And with that, we really never knew how to raise money, what to do. Quite frankly, I wasn't very even business savvy to understand P&Ls and everything. And we had an incredible mentor that taught us what to look into a business. His name was Brian Gallagher. He ran a transportation company, seasoned CEO, super smart guy. I mean, he used to tell us, like, meet at my house at 6 a.m. and we'd go to his house, sit down and go through everything. It was an incredible experience from understanding that side. But when it came to like raising money, we didn't know anyone that has done the non-banker route. So what he was teaching us how to get the money from banks and all of that, but we were 22 years old, no credit, no nothing. So we started emailing all these venture capital firms and all of these things. And then we got into this circle of people that quote unquote has done it, but everyone told us a different thing. And our mistake was we were constantly just changing everything. And there was like no controlled pitch or controlled approach, because I would go to John today with pitch A, to Brian pitch B, to Jimmy pitch C, somebody else pitch D, and it was constantly changing. And there was no idea of what was working or not, because we were just kind of like desperate and
What, did someone tell you to switch the pitches up?
We were talking to different people. Oh, you have to do this, you have to do that.
Cater the pitch.
And what we decided at that moment, justifiably so, just because of an experience, everybody was smarter than we are, and everybody knew what we were trying to do better than we did, and we were listening to everyone except ourselves. And it just happened to be this thing where we really pushed for like a year and a half before we finally said like, this is not going to go anywhere. But I think in that year and a half, I probably could have also done a ton more bootstrapping work to even get that off the ground a little bit more. So I wish we worked on organic growth and trying to make it work ourselves instead of just chasing money.
What business was this for?
It was this business. It never took off. It was called Desk Quest.
Well, first of all, this is a horrible name. Just
I remember it was too.
Yeah.
Brian, you were
Wasn't it
tuned out in
Desk-
the beginning of this
Desk
conversation,
Quest?
apparently.
Yeah, Destination Quest. Yeah.
just a tongue twister. I'm glad it didn't work out.
I'm glad it didn't work
glad.
out. That's
Well,
so
that's a
terrible.
bad
Because you
name.
wouldn't want to have to say it.
I wouldn't have had to say Desk Quest.
Look, I think the thing that I heard when you talked about this story is like the typical things you hear about. You had envy across other founders that you can go get money. Couldn't be that hard. 2, you listen too much to people's feedback. I think listening is good, but you reacted to that feedback, which was bad. And 3, you probably weren't ready anyways. It sounded like there was a lot of things that you weren't ready. And that means why the investor probably wasn't. And if you're listening to this pod and you're like, man, like I haven't been able to raise money, maybe you have to turn around and take that perspective against yourself and realize that, dude, you got to be ready. Like not all entrepreneurs are ready.
And I'll tell you this now from 2 perspectives. If I got money from somebody, they wouldn't have seen a return on it because I wasn't ready. And 2, even with the company that acquired us, when I joined part of the acquisition, when I look back, I feel, and it's not a fault of mine, but I wish I would have brought the experience I have today and the knowledge and the way I think to that acquisition, because I think I could have contributed to the success of the acquisition, how to talk to the CEO, how to manage certain people, like the politics of it, how to look at the P&L. Like he, for example, never shared a P&L with me, and I would have probably been like, look, if you want a successful partner in this, I got to know the finances.
Absolutely.
But these are the things I was like, oh, I'm going to take a backseat. And I was just frustrated, and it just boiled over. So like right now when I look at all of this back, and it's easy to say, but like I'm glad people didn't give me money, but I also wish I would have matured faster with the previous acquisition where I could have been more impactful to the business.
100%. That makes sense. And John, when we go and we think about moving forward, I know the story has been that you obviously sold, but then you reacquired the business.
Right.
When you think about that lesson, like you think about what happened, right? What's the lesson you take back from that whole story?
From just the story of buying the business.
Yeah,
back?
like the decision to sell it and then the decision to buy it back to obviously go off and sell it one day.
Yeah, I mean,
Was it strictly just a business dollar money function, or was there like a lot more deeper thought around why? I guess this is the question I always ask people who run it back. I call it running it back when you buy it back. Why? Like, why run it back again? Because a lot of times, at least for me, when you're done with something, you're done with something. Like you don't want to go back and try it again because ultimately you usually come back to the same feelings you had.
Well, you got a good deal. You got a really good deal.
Yeah, so I think that's traditionally correct for us. I think, yes, there was some passion. We did love the business. I love BattleBox, but I think maybe I wasn't ready to leave yet. But at the end of the day, it was arbitrage.
Yeah.
It was just the fact that we had gotten the payday, and a year and a half later and that's when it closed, a year and a half later. The reality is, we were having the conversations with LOIs getting almost signed at the year mark. It was pretty quick, the agreed upon piece, but it was the arbitrage piece that it was just such a good deal. And so another point is we had gotten that payday. The way the deal was structured was it was cash up front.
Yep.
There was no stock. It was all cash up front. And the stock and other stuff was in the earn-out piece. Looking at it from this arbitrage standpoint, we had gotten cash. The original plan was we were going to raise $6 to $7.5 million to buy the business back. And it was, okay, well, we already got paid the first time. We're going to keep that, bank that. We're not even going to touch that. And then we're going to raise a round and get this business back. And, it's just pure upside. It was very situational.
Yeah, yours is situational because often when that story happens, you leave the business and then you come back to buy the business back, right?
Right.
That's the typical story.
Yeah.
And I never know why people want to run it back, but to your side, you never left.
Still running it was an independent business unit.
Yeah, that's really interesting. All right, I want to go into the future a little bit. Before we jump into Brian's game here, I want to talk about the future, right? Now, we've seen this cycle of investments out there, and I've got some stats here. They say that it was last year in 2023 versus 2024 to 2023. We're now 26% slower in investments in the market. But then 2023 to 2022, we had a 38% decline. So we're seeing a fast, rapid decline. And in D2C, as you all know, is pretty dried up in this market because no one's fundraising. No longer are you getting 6x, 12x top line multiple on a D2C brand these days.
That's not happening.
How do you guys think about the future? I mean, to me, I was thinking about this And the question is really like, how do you see the future? Is it hybrid approaches, things like crowdfunding, revenue-based financing, debt agreements? What's on the horizon as we're thinking about the future of what raising money might be? Is it that we're tightening back up and taking it back, or are we thinking that it's going to change in the market over time?
Well, I don't think it's ever going to get to where it was at the peak.
Yeah.
I just don't think. we'll
Well,
get
they
there
say
again.
every 8 years. I mean, what happened? The dot-com boom was the same thing.
Yeah.
Right?
So that's a really good point, and we don't remember.
Yeah,
We're
we don't
very
remember
short.
it.
Yeah.
2008 was the same thing. There was a lot
Yeah.
of money. There was also frothy money in 2015, 2016,
Yeah.
and it imploded in 2017. We didn't go into recessionary, but 2017, there was a slowdown in the market for a while.
So I guess the one thing that's where I don't think it's going to be exactly the same as it was maybe back then is there has been further learnings on the D2C brand side from an investor standpoint.
Got it.
They've realized they can't scale it like they can a software company. They're going to, where they just acquire. It's never going to pan out in the way that they can with other types of brands. So I think even if it goes back to the frothy craziness of 2015-ish, I don't think it'll ever be the way it was for D2C brands.
Yeah, they're not going to take off at least a SaaS multiple. Like
Right. Yeah, I would think-
everyone's gotten back to EBITDA at least.
Yeah,
and
five,
moved
five,
quicker.
6, 7, unless you're over.
Let's just say you're crazy. You should get 10, 15. Let's just say you get 10 to 15 times EBITDA. That's still a really good deal when you're fundraising on a valuation, in my opinion, right? But people are looking for 6 to 8x top line revenue, which is so inflated when you're
It's
in
not
the brand
happening.
side of
Right.
it. No. What about you? Got any thoughts on the future? Anything you think is going to happen?
Well, I'm going to go back and I'm going to go forward. So I've been saying this thing, John, and I talked a lot in the past. What happened during that wave 2020, 2021, I'll call it an artificial economy. A lot of people pumped these hopes that SaaS and e-commerce were just entering this brand new phase, but
A wave.
Yeah,
a wave
to the
or
moon.
what, like, I mean, everyone was saying, oh, e-com is going to take over brick and mortar. Look at this fast pace, and everything came from Shopify, from Adobe, from every single platform. And it's like, I was saying there's no way, because we were printing checks from the government and giving it to people to spend it. They're sitting at home. What else are they going to do? So I think moving forward, one thing that scares me, and I talk about this a lot, especially for D2C brands, I think we're entering this new wave of globalization. Before, globalization meant how do we as American companies export and utilize the international workforce, like as we do at Perella and many other manufacturers, to import things to America and then sell it. And that was called what we taught about globalization, kind of export of jobs. But now are we only entering export of jobs? We're also battling import of foreign-owned company products. And I think there's going to be a lot more competition than there ever was. We know Brian is hugely fond of Temu and things like that. I think the problem is going to get a lot worse, and there's going to be a reactionary period. I don't know what that is, how the government is going to handle it. I think for D2C, that is going to kill funding because the market is going to be so saturated. And then I think honestly, for B2B, for SaaS, I think SaaS investments are going to dry up. I think there's going to be, I know you're big on this, Jimmy, the AI wave. I think a lot of people are going to start investing a lot more to AI. I think, and the more I talk to you, Jimmy, the more I believe this actually, I think SaaS is not sexy anymore.
We're going to downloadables, man.
Yeah.
The cycle is happening. Dude,
It is.
The future is John's going to go eventually to a place where he's going to buy a downloadable software that he's going to self-install into your own hosting, and you're going to operate that software, and it's going to do the same thing that you're doing today, but with no monthly recurring cost. You'll pay for support when you need it or updates when you want to buy it. But that's where we're going. We have to be going to that direction because that's the only direction that makes sense right now. SaaS is not a long-term play. And I don't know what the world's going to do and all these investors are going to do in the market, but like that's changing right now with the availability of technology ultimately right now. That's the big thing that I see into the future, and that's going to change. And that doesn't mean that you're not going to get funded. It just means that funding is going to be different, but also you don't need as much anymore.
But think about it too. Like, when was the last time you looked at a SaaS solution and you were like, oh my God, that's so innovative and so great?
Only ones that are innovating into the future, like something like a Coinbase or something. That's a SaaS technically, right? Like
Yeah.
a marketplace, right? But like technology, but not often. A lot of the newest stuff now happening is cool, different, but are they really being super? No, they're not. You're right.
Yeah, but everything that we find cool these days is at a shock factor. We were watching Elon's Tesla release, robotics,
was shock
AI.
factor.
Yeah, that was
It's
pretty
like,
cool.
That was
whoa.
awesome.
And guess what? All the investors have the shock factor too. It's like, why am I going to give a bunch of money to
A software company.
Yeah.
And we're going from developers and product people being in charge of, I think, software companies to engineers and marketers. I think the only SaaS companies that are going to survive are people that have incredible marketer founders at the helm. They can really out-savvy the company competition from a positioning market.
And Amir's just taking hot takes. He went into 100 mode. He went into all sorts of different things that he's talking about there. But you're right. I agree with you, Amir. I really do think the future is changing right now, and we're hitting that next wave. And the thing about every wave is there's always people that are going to hold on to the old one, and they're going to stay. And there's nothing wrong with that. And 20 years from now, they'll still be doing the same thing because they don't evolve and grow because they're not willing to, and that's okay. We need that. Unfortunately, we need that to happen. We need people to fall behind to take care of the old stuff while the new stuff goes into the future. But the future is changing, absolutely. And I think even funding, as I said, like revenue-based funding, crowdfunding, you can raise $5 million now in crowdfunding.
Crowdfunding is an interesting piece.
Without ever. And like BattleBox, for example, or OMAs, you guys are probably perfect companies for crowdfunding because you have a lovable customer base that you can go off and say, hey, you love OMAs so much, write $1,000 check and you'll own a very small sliver of OMAs, but you can at least say you were an investor in OMAs. And people want to. Yeah. They want to support. We've learned it that, especially in this generation, people want to support other businesses. All right, I want to close this thing out because we've been going for a while. And I'm ready and excited to introduce you to Buy or Sell. Here's your host, Brian the Meat Guy.
Ding, ding, ding. We can have
Mo
add in.
Mo put the noises in right now. There you go.
Buy or sell. All right. So here we go. So this is 5 topics. I'm going to say a statement. Okay. It's not a question. It's a statement. And we're going to go around the room. We'll start with Amir for this one. And you're going to buy it, which means I believe in it. Or you're going to sell it like, I'm going to sell it. All right, Amir.
If I sell it, how much do you give me for it?
Amir, let's get on track. So, all right. Welcome to Buy or Sell. First one. It's worth giving up control to investors if that means faster growth.
Sell.
Okay.
I was told I can't do anything else.
That's it. You're done. John.
Yeah, I'll go sell as well.
You go sell. I'm going to sell that one. I don't know how you feel about that one, Jimmy.
I'm going to go buy on this one.
Okay.
Because I think that if you have a great idea and concept, it's okay to let go of control if it's a real, like, I want to go do something cool in the world. Unfortunately, like, you need more people to do it. You can't just rely on yourself sometimes.
Yeah, that's a good point. All right, then we'll go back with Jimmy here. Bootstrapping is less risky. Buy or sell. Bootstrapping is less risky.
If you're asking for myself, I say buy. If I'm asking for the general population, I say sell.
Okay, all right. John?
Yeah, I think it's a sell. To me, it's definitely way more risky, right? It's your own money.
Yeah, I agree, Amir.
To me, I'll say it is less risky because of the way I did it. I sacrificed, similar to John, actually, you worked 2 jobs until you joined BattleBox. I'll buy it. I think it's less risky.
Yeah, I think it's more risky just because I'm in that like family bootstrapped environment now. So it's so many family members are relying on each other's money to succeed and grow. And number 3 here, we'll go back to Amir. Fundraising sets up businesses for longer term success. Buy or sell?
Sell. I've seen very well-funded companies burn in a couple of years. So I think it's up to the founders and who the leaders are.
John?
I'll go sell too. I mean, the reality is when an investor puts the money in, they want that money out in 2-3 years, right?
Yeah, I'm with John on this one. What about you,
I'm
Jimmy?
with you too, sell. Never have I seen a fundraise business as a better operating than a good bootstrap business.
Yeah. All right, number 4. John, we'll start with you with this one. Securing VC money improves your brand image and attracts more talent. Buy or sell?
I'm going to go sell. I definitely could see the counter argue on it being buy for some, just simply because with that money, you're able to get some really great talent. But for me, it's definitely a sell.
Amir?
Short term, yes. Long term, no.
Okay. Jimmy?
I definitely buy there because I've seen it.
Yeah.
The moment you raise money, dude, the people who come knocking on your door are people you'll never get if you're bootstrapped.
Yeah, I'm with you on that one. I agree. And last but not least, this is a good one. Amir.
Thank you. Finally, look at that.
Enough.
Can you say it again? Just one more time.
Oh, because you said your name right?
Amir.
Yeah.
Amir.
Yeah.
Still don't agree with it. You can't scale effectively when you're bootstrapped. Buy or sell?
Sell. I've done it.
Okay. John? Thanks for the feedback there, Amir.
You're welcome.
Yeah, it's a sell. BattleBox is established right now, but if we want to scale right now, we absolutely can.
Yeah.
But it's because we are established, because we've been out for a while.
Yeah, I'm going to sell that one too. What about you, Jimmy?
Totally, I'm going to sell on that one. I don't think if you get to a place of scale, that means you've passed like that early stage of death at some level. So to me, that's 100% a sell.
And scale is a very
It's a broad term, right? It's like
we talked about this.
Yeah.
All right.
Buy sell. That was fun.
That was it.
Well,
You do
that's
this
exciting.
We'll do it again. We'll do it again.
We'll do it again. Next episode, we'll do it again. Bring some more for us.
100%. Let's do it.
All right, so guys, that's a wrap. Episode 23, Funding and Bootstrapped Entrepreneur's Decision. Guys, if you enjoyed this pod and you like what we're talking about, please like, comment, subscribe, tell a friend, and let us know what you think. You can find us on X, TikTok, IG, LinkedIn, YouTube. Just type in Awesome Pod to find us. And don't forget to leave us a review or rating on your favorite podcast stream, Apple or Spotify or whatever the crazy Android users use out there in the market. But remember, we're a video first podcast. We fly location to shoot this as a team, not only for the dynamics of this pod, but because we want to create a high quality experience. In fact, today we're here in Chicago, in the land top 6 city in the world.
And episode 23 in the home of Michael Jordan. I could not be happier. It just hit me.
Oh, okay. See, look at this guy.
Look at
He's
that.
just been angle shooting us about
He's been
Chicago.
so happy about
Best
it.
thing in the world.
Happy. The man has made us an itinerary and plan, and we don't like itineraries and plans, but this guy wants to make us a plan. He's like, at 8:04, you'll be eating this pizza, and 8:06, you have to have a jelly bean. And we're like, geez,
Ryan,
Mayor.
what did you say when we had to pick up the pizza?
I said, wow, this is cool, right?
No, you were taking pictures. We went to so many cities.
Yeah,
it
you
was the
sent the
only
pictures.
time
I took
you
a
were taking
video. I mean,
pictures and
I
videos.
took a video. You know,
No
I
better
took a
city. I
picture.
don't care what anybody says. I will
I'll
fight you
give
in a
you
ring.
top six
Top-
in the U.S.
I will stomach top 3. It's top 1 city.
Hey,
Remember
if you hear this and you have an idea what the top city is, put it in the comments.
Remember when he
Let
said
us
it's the
know.
safest?
No, there's no way this place is safe. They call
It's
it
one of the
Chirac.
safest cities. It is.
You can't have a nickname
we
called
were- we
Chirac
were at
and then
fa-
be
we-
considered safe.
We were at Family Dollar. We're walking. He goes, "Oh, by the way, if we kept going 5 blocks up, not good." I'm like, okay.
I'm saying it changes. It goes from a yuppie neighborhood to a more diversified neighborhood. There's nothing wrong with that.
All right. We're gonna
that
end
way.
this. We're gonna end this conversation. So don't forget to subscribe to awesomepod.com to subscribe to our newsletter. Join the newsletter that we have coming out into the future. Special thanks to our sponsors, Recharge, Salvit Advisors, and Nacelle. The next episode, guys, we're gonna talk about founder marketing. We're gonna continue diving in here, and we want to talk about founder marketing because it's definitely been a conversation. I've got a ton of examples ready and lined up. I'm excited about it. Thanks for tuning in, and we'll see you on the next pod.
Buy or sell.
Welcome to the Awesome Pod, where we talked a lot. Ecom was the path that we walked a lot. But now the question is, will you subscribe or not?